Okay, students who are taking financial accounting, in this series of videos we are working on the assigned homework problems from the digital study guide for chapter 9, which are the short exercises. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. And, excuse me, in the last video for problems 9, 8, and 9, I kind of like just work through them. And by the time I finished the video, I felt as if you didn't understand the underlying concepts, it was possible that you're not going to understand how to do those, how to think about the interest rates on the bonds. Okay. And as I glanced down at problems 9, 10, 9, 11, these are short exercises. Trust me, you're going to get a lot of exercises on how to do bonds. Okay. So, and these are the short ones. All right. When you get to the exercises and the problems, they're going to be even longer. So at this point in time, realize that if you don't understand the theory, you're going to struggle with the problems, period. So go back and rewatch the theory videos, bonds 0.1 through 0.6. Go back to your Math for Business and Finance and Math applications and watch the videos back there. Read what was in that textbook if you have that textbook still. Get the theory down, because you have to understand the underlying concepts of the bonds in order to be able to work through the problems. I mean, and that's what this, slide is all about. I mean, that's what accounting is all about. So as I thought I'd take a minute here to let you know that as we move forward, okay, I'm not going to keep on going over theory that was already covered in a previous video. I'm going to work through the problems and try to point out the theory along the way, but I'm not going to explain all of the theory. So as we move forward here, these bond problems are going to get more and more difficult. All right, so with that said, Wilson Corp issued a 6.5% 10-year bond with a maturity value of $30,000 on January 1st, 2014. All right. Journalize the following transactions and include an explanation for each entry. The market rate of interest equaled the stated rate at the date of issuance. Okay, so if the market rate equals the stated rate, that's if the interest rate equaled the stated rate, the market rate of interest, then that's at parity, at par. Okay. I like to use the word parity better, because when we have the $30,000 bond, right, that's the maturity value, and it's at 6.5% interest for 10 years, right? That's the bond issued at par. Okay, so if the market interest rate is equal to the stated rate, okay, and the stated rate is 6.5%, the market rate is 6.5%, because it's at par, it's at parity, it's equal, right? Now remember, the price of that interest rate goes up or down, all right, which causes the premium or the discount, all right, on the bond, right? So if that par value is 1, as a price is 100, and it goes up to 110, or it goes down to 98, the difference between that 101 or that 98 is the difference, like in an interest rate, which causes the value to change, because the bond stays at $1,000 bonds as a face value, and the maturity value stays the same at 30,000. So 30,000 as a maturity value means I have 30 bonds at 1,000 each, which is equal to the $30,000 of maturity value. Okay. So A, issuance of the bond payable at par on January 1st, 2014. Right. So if I'm going to issue the bonds, All right, think this through. When you're making a journal entry, am I affecting cash? Yes. Okay. Why? Because I'm receiving 30,000, I'm selling the bonds. I'm receiving $30,000. So I debit cash for $30,000. And debits have to equal credits, so I have to credit something else. Well, I owe that I received the 30,000. I'm going to owe that 30,000 sometime in the future, so I'm going to credit bond payable, right, for 30,000. Right, B, the payment of the semi-annual interest, so interest is semi-annually, right, on July 1st, so on 1/1/2014, right, we have to calculate our interest. Well, what's our interest, right? Our interest is 30,000 times 6.5% times 6/12. Okay, do the math. All right, you could have done it one of two ways. You can either do it this way, multiplying 30,000 by 6.5% by 6 and then dividing it all by 12. But we could take 30,000 and multiply by 6.5%. 6.5%, which is 1950. And since it's semi-annual, so we're going to divide that 1950 by twice a year, and that gives us $975. So our interest semi-annually is $975. Well, we're paying the interest, so am I affecting cash? Yes. Cash is going out, so I'm going to credit my cash for $975, and debits have to equal credits. So what am I paying? I'm paying interest, so interest expense for $975. Okay. Then it says C here, payment of the bonds payable at maturity, and give the date. Okay, so it's a 10-year bond, right? So at maturity, it's going to mature on 1/1/2024, 10 years later than 2014. And we're going to make payment of the bonds payable. So, we owed that $30,000, so we have to give that back. So am I affecting cash? Yes, I'm going to credit my cash for the 30,000, and debits have to equal credits, so I have to debit something else. So what am I going to debit? Well, it's what I owed, which was the bond payable, so I'm going to debit my bond payable for 30,000. Okay, so those are the journal entries, but I want you to realize that when you look at these, if you drew out T accounts, you'd see this a little bit easier. But realize that you received cash of 30,000, so that was a debit, and you paid it out at maturity for 30,000. So that basically washes out that account, okay? The ending balance being 0. Now, you had a credit to bond payable, and when you pay it back, you have a debit to bond payable. So that washes out the $30,000, okay? So remember what the purpose of the bond is you're getting money now, and you're going to owe it back, right? You're going to pay it back at some other time. So those accounts should wash each other out, meaning ends up being 0. And the cost to you for borrowing that money is your interest expense every 6 months over the course of 10 years. Now, remember that interest expense, the person buying the bond, they get, that's their return on the investment. They're getting that interest on lending you the money, right, by buying the bond. You get the interest. You have to pay the interest, and when you're looking at these journal entries in a vacuum here, it seems like, oh, well, why would I do that? I'm paying out interest. I get nothing for it. But remember, you're taking that money and you're doing something else with it. And your something else that you do with it, you expect to generate revenue. Okay, And if you generate revenue, it should be greater than the expense, greater than that interest expense. So you would be profitable on, whatever you did with that money. All right. So you get the money, you make revenue. Sure, you have to pay out interest, but you're generating a profit based upon what you do with that money. And the investor who's buying the bonds, they're getting a return on their money. Okay, and that's the way bonds work. Okay, let me look at 911 here real quick and see if I'm going to work this in this video or the next one. Generalize and use the straight line method. Okay, so since I'm going to use the straight line method for amortization, and I'll end up explaining that a little bit, I'm going to stop this video and pick up with 911 in the next. But again, and I'm not going to repeat this in 911 so much, but go back and watch the theory videos. You have to understand the underlying concepts. And if you've watched the videos, read the book, gone back over your math, and you still don't get it before you work the problems, then feel free to telephone and speak with an instructor. So see you in the next video.